Hello, YouTube. The S&P has stopped going up, which means we want to be prepared for downside. And there's a scary stat that we talked about recently, which is when the S&P goes up by more than 20%, which we just notched, 85% of the time we get a drawdown of more than 5%. So what that means is that it could be a dip of 30%, could be 15, could be 10. I'm not sure exactly what it is. But like we mentioned, now that we have stopped going up, we want to be very mindful that if it's time to go down, we have to be aware of targets. We've been going over this story for quite some time. If you hang with me for the video, I think you're going to get a lot of value. So please stay tuned and hang around as we try to understand exactly what could happen, because I think 15% of the time is not really that great. 38% of the time, or basically 1/3, it is between 5 and 10%. 38% of the time, it is 10 to 20%. That would be a correction. And a bear market would be 9% at more than 20%. So is it going to be like the 1940s, 2009? Stay tuned and let's go through that right now. We have an update here to that crash signal we talked about last weekend, where every single time so far this year, even going back to the all-time high, we have a very repeatable pattern, which we talked about last weekend. Hopefully you had a chance to see that, but we'll walk you through it really fast here as an update. 2 red candles in a row, closing below previous weekly candle lows, and then just opening with a third red candle. So what do we have? We have it exactly here. We have it here. We have it here, we have it here, and we have it here. However, there's another really interesting diagram that I'm looking at here, which also tells us that we have a crash signal, which I believe we brought to about 3 to 4 weeks ago. So we're going to give an update to that now, because here we're looking at the US 10-year note versus the S&P 500, and who was going to blink first. This post is from a while ago, but if you want to follow me on Twitter, the link is in the description, and you can also see what it is right there. All right, so let's get an update on that chart, because we're getting awfully close here. And when we look here, we note that March of 2022 is when we formed that new high. And right now, we're within 5% of going to a new high. So why does this signal matter? Well, because right here is March, and that led to a 20% correction. That led to the bear market actually starting. So if you want to know how the bear market started, well, there was a very big clue. It was the 10-year Treasury note going to a new high, which we can see right here. It's a new 52-week high. So I'm calling it roughly 4.3. It's actually 4.34 for us to actually get there. And what's a little bit ominous about this too is that even if we look back here to 2018, when we actually breached to that new high, it's right here around January of 2018. If we go back in time a little bit further now, we're going to see that this also provided a very good clue. So let's go back to 2018 here. We're looking for January. This right here led to a 2-week drop of 10%. So just to make sure this is clicking for you, when we go to a new high, it's January of 2018. We look back to our chart here, January of 2018, there's a 10% drop. So I am not going to ignore this pattern. I hope it doesn't play out. I hope it is a shallow dip. But as we all know, hope is not an investment strategy. And I'm going to ask you for a huge favor. If you could please just consider smashing the thumbs up and subscribing to the channel. I would greatly appreciate that. We put out stock market videos every single day, and we would love your support. So thank you very much ahead of time. All right, let's move forward. So we talked about the crash signal potential for the 10-year note. Let's get that out of the way. Let's close that one out. There's still the potential for the shallow dip, which right now we're still seeing some evidence for. But let's just make sure we understand that if we're going to be getting a crash signal, and now we have basically all of the recipe other than the third weekly low, meaning a red week, how low could we go? We know that the market generally takes the staircase up, which we've been doing since the beginning of the year, and the elevator down, elevator down, elevator down. That's a dip. That's basically 2 pullbacks there. So what could happen? Well, let's give an update to this chart and see if we're getting any more warning signs for August as we go into September. Let's look here to the S&P. What do we know? We go down and then basically sideways. What are we looking here on our seasonality chart? Let's get nice and close to make sure you guys can see it. 1 cut, 2 cut, sideways. All right, one more time here. Let's go back to SPY. 1 cut, 2 cut, sideways. So what we have to remember is that here we're looking at a line chart, and all it cares about is the closing price, which means that's what the seasonality chart cares about. So we definitely still have some evidence here for the bulls to say that they could still come in, they could still save the charts, and that's how we can go to new highs. And we'll give an update to the graph. We talked about how we have the consolidation pocket, which could lead to new highs. But let's just make sure we understand what's going on here. I've talked extensively about this 50-day moving average, or basically the short-term price, and it has not been lost yet on SPY. But here are some very important charts which have. Here we're going to look at QQQ. What do we have? We got 3 consecutive daily closes below that 50 DMA. That is not good. That's the NASDAQ 100. And what do we know? Well, chips lead tech and tech lead SPY. That's not good. So 3 days below, which means there's going to be that pressure coming to the downside. Apple now has 1, 2, 3, 4, 5, 6. 6 daily candle closes all below the 50 DMA, pretty much happening right after earnings. A kiss of death on the 50 DMA also tells us that we might leave this gap as we go to start to fill all these downside ones as we look back to the move to the all-time high. All right, moving on to Microsoft, second biggest stock in the market. We can clearly see it has lost the blue line, or that 50 DMA. It is below it for quite some time now, and back below its previous high. NVIDIA, third weekly candle close below. And ironically here, as we look to NVIDIA, we can also note that it's basically backtesting its $1 trillion valuation, currently worth 1.009 trillion. I think that's going to be a very important number for the stock as well. Moving forward, we got Tesla. If you're not noticing the pattern quite yet, these are the most important stocks, and they're all below for America. If we look over here to SMH, it has now got 3 daily candle closes below that 50 DMA, and it just notched one of its worst weeks, if not the worst week so far this year, down by 5%. So we're noticing that chips are leading tech, tech is leading SPY, volume is starting to come in, and this does not look pretty. We also have ARK, or Momentum, unprofitable growth, spending multiple days below that 50 DMA. All right, so this does not look good so far. It looks like the bears are building up momentum. That crash signal could be here. The DAX, or Germany, has 8 daily candle closes below the 50 DMA. Hopefully you're noticing the pattern by now. Short-term momentum is pretty weak. And then we got EEM. Here we got 4 daily candle closes below. So this would be like the rest of the world, emerging markets. And then finally, Japan, which has been a massive, massive, massive gainer so far this year. What do we got? 1, 2, 3, 4, 5, 6, 7, 8 days below the 50 DMA, just like the DAX, which means we're seeing not only America, we're seeing tech, we're seeing Apple, we're seeing Microsoft, we're seeing chips like NVIDIA, we're seeing Tesla, we're seeing SMH, or the semiconductor ETF, we're seeing unprofitable growth, we're seeing Germany, we're seeing emerging markets, and we're seeing the Nikkei all spending significant time below their 50 DMA. As a rule of thumb, I like to say that if a stock spends 2 days below an average, that is where we start to see the potential for a trend change, but it is not confirmed until we actually keep going lower. So all we're getting right now are still warnings. But let's pick the story up where we left it off a few weeks ago as well, where we're talking about this 4-step pattern where we have a crash landing to our 50 monthly moving average, a poke below, a 5-month expansion, and then I was unsure. This post originally goes back to July 8th. So this is now quite old. We're here at August 12th. It's over a month later. Let's look and see what happened to number 4 and number 5, because you might be surprised. Oh, okay. So we talked about this on our Friday stream. The arrow is pointing to the red box. So as you can note here, as we're now inside number 4 just shows us that we're currently consolidating. So this current consolidation could lead to new highs because we crash land on the 50 monthly moving average, expand for 5 months, take out the first high for 2020. That meant a new all-time high. For us, that means getting above 43.25 or 432 on SPY. And as we break over that area in perfect harmony, 5 candles up, 5 candles up, and now we have that red candle. Here we got the red candle. The part that's missing is we don't quite go to a new high. Here we don't have the new high yet. So like it's close enough. The saying is that history does not repeat itself, but it often rhymes. So as we looked here to that last pattern, what it tells us is that if we now have 4 out of 4, it's like, well, 80% of the recipe is now playing out. The new highs are the thing that I'm less confident about. So what would it take for us to go to new highs? Well, we'd have to take out the high we just established. It's that simple. So right now, that high would be 4,600 on SPX. And then we can battle for roughly 4,800 or our all-time high. So what a lot of this really comes down to is positioning. So if we look here to, again, we went back to 2018. We're now going to look back to 2016 as well, just to see what happens with this big short, because there's actually been a reduction of about 40,000 contracts, which means like that's like quite a bit. The bears are capitulating right now. And I think the reason why they're capitulating is because, man, this has been a painful ride for a long time. What normally happens, just looking here to history, big short, double down, go net long. Big short, double down, go net long. Big short, double down, go net long. So if we're going to go to those new all-time highs, it could easily be just from the shorts starting to cover, and they're doing it at a time when we're still in greed. So what does that mean? Remember, these are opposite feelings for the bears. So if you're bullish, you're still feeling greedy. But if you're bearish, meaning you think stocks are going to go down, man, you're feeling some fear. You're not feeling good right now. And this is not what we really want to see if we are bearish. So bears have some key areas they have to defend. And if we look here to when the big short started here in roughly June, we're now going to have a look at that chart here for a volume profile. I'm going to ask you one more time, please and thank you. If you could please consider smashing that thumbs up and just subscribing to the channel if you're enjoying the content. We do put out stock market videos every single day. And if you want more content, again, I do have that Twitter account you can go follow at Justin Caron. And we also do have a 14-day free trial if you're interested, but we'll talk more about that at the very end of the video. All right, let's keep the story going here. So what do we have? This is the E-mini futures, that chart we just looked at, or the CFTC net short data, where it goes back here to roughly June of 2022. And here I just have the price starting in June of 22, or where everyone wants to really get short. The Fed tightening cycle begins, one of the fastest in history. And we note that we have some key areas here. We note we have big fat bars here. Red means sell, green means buy. So if we're not able to hold this 44.50 area, which we're currently throttling, 44.64, we're not really off by that much. We notice there's a pocket of supply right here, supply and demand. If we lose that, man, I think it's almost inevitable we're going to backtest 4,200, if not the biggest pocket here at 4,100. So that's really important. And I really want to pay attention to that CFTC net short positioning, because I think this is really going to be a big deal. They've been in a painful trade for more than a year. They've been right, but they cared more about being right than making money. Here's one more stat I want you to pay attention to. A week of 1% moves on the S&P could trigger forced selling. Keep that number in mind there, forced selling. 1 week of daily moves. This is from BNN Bloomberg. So now we're going to look at a Bloomberg article where it tells us that market moves are exacerbated and no longer muted. Blah, 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 right? Rumor, who has studied flows and funds for 2 decades, wrote in a note on Thursday, this is new. Volatility picks up. S&P 500 daily swings have widened in August. We can see here that the daily percent range, meaning the percent range on the day from high to low, has now been increasing. So when we look at that seasonality chart, a lot of it is muted because we're just looking at the closing price. But let's read the stat right here. Again, remembering that a 1 week of 1% moves on the S&P could trigger forced selling. Now let's read this note here. Stocks fell for a second week, blah, 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 for the 5 sessions through Thursday. What's 5 sessions? It is 1 week. What was that article again? 1 week of 1% moves. All right. Hopefully you're following along here. For the 5 sessions through Thursday, the S&P posted an average intraday swing of 1.1%. That's how we got all the way up to here. So that's telling us that we could have what? Forced selling. Forced selling means we could be going lower. So that seasonality chart might actually end up hurting us. Why? Right now, liquidity is low. But if we try to understand what is the catalyst for us to go, is it going to be positioning? Is it that fear and greed? Or is there something else? When I look to the earnings for this week, it's not that there's nothing. There is like Home Depot. There's companies like Target. There's Cisco. There's Walmart. I don't know. Again, I don't think, I'm not confident, but I don't think this is what's going to move the market. So what I'm trying to find out is what could move the market. And I don't really see anyone particularly talking about this right now. It is on Wednesday. We're going to get those FOMC meeting minutes at 2 o'clock. And this, I think, is going to move the market. Why? Because it's going to tell us the current rate of the Fed thinking in terms of federal funds rate or the interest rate. So let's look at a few other stats here. We're going to look at GDP. And this is pretty staggering because when we look here to the current year, man, we had 1% in Q1, 2% in Q2, and a whopping 4% in Q3. So those minutes from the Fed are going to be backwards looking. But man, I don't know how the Fed is going to say that they're getting the job done. Everything is accelerating, right? We're noticing the acceleration. So it's a double-edged sword. This is good because it means the economy is strong. But when the economy is strong, people tend to what? Spend more. As they spend more, we see more inflation. It becomes a wheel. It becomes self-fulfilling. That's called the wage price spiral. We're not going to talk about that today. But anyways, here we have another thing we want to look at here. So higher for longer is one thing. But here we note from Goldman Sachs, a $2 trillion corporate debt wall will spark job losses in 2024, Goldman Sachs says. So this is, I think, a little bit bullish short term, but massively bearish as we go into 2024 and 2025, because we have $230 billion. This just shows how much, how much corporate debt is going to be maturing. So this year, remainder of 2023, It's not all that much. It's currently here at about 200 billion. But next year, man, there's a lot more. There's going to be 790 billion in 2024 and $1 trillion in 2025. And then it's going to go even higher. So they think it's going to lead to job losses. So that's how we could get that unemployment rate actually going higher. So again, what does that mean? Well, GDP is strong right now. It could go strong into the end of Q4. And then as this debt wall is going to start hitting next year, people are going to have to start paying back their student loans again. That moratorium is going to be put on pause. Well, this is kind of a double-edged sword as well, because I don't know if people fully appreciate. Again, I think I understand this, but let's see if we can understand the picture a little bit better in terms of the reasons why we got those downgrades from Fitch and also from Moody's this week. Here we're looking at the Fed funds rate, and it basically tells us the current rate of the current rate of interest that the Fed charges. So we note that we have an expansionary period here where we have higher highs leading all the way to the 1980s, 1970s, and 80s, where Paul Volcker was the big god, right? He killed inflation. So here we have high, lower high, lower high, lower high, lower high, lower high, lower high. But now we have a new pattern, higher high. Why would this matter? Well, we just showed you there's $2 trillion in debt that's going to be coming due. So if they're locking in rates at a higher rate, and it's going to be, at a lower rate, but they mature next year or 2025, man, if they got their loans in 2020, 2021, interest was like zero. It was free. And then it went from 0 to 5%. That is a massive, massive jump. So when we talk about higher for longer, people are now actually pricing out the cuts a little bit more. So right now, if we go to the CME FedWatch tool, it basically tells us when we're expecting Fed funds rates to be in the future. And right now, there's a marginal cut now baked in for March 20th of 2024. It's a 36% chance. Then as we go into May, now there's a greater chance we're going to be at 500 basis points, or basically 5. Remembering that right now, we're currently at 5.1. So we're not looking for a very big cut. And we're talking almost all the way out to the end of next year. And why would this matter? Make it very, very simple for me. Well, I'll show you two numbers here, because everyone's talking about, yes, Fed's going to pivot. Fed's going to pause. A pause is bullish because a pause means we're getting relief. However, if the Fed's going to pivot and we're talking about 2024, let me make sure this picture is crystal clear here. We're looking for a cut in interest rates going into March of next year. And we also have this massive wall of corporate debt coming due. Let me just see if I can pull that up here. Not sure I have it. Here we go. Coming due in 2024. So if all that stuff is coming due in 2024, why would that matter? Well, it really matters because that's when the market's expecting a pivot. And we see declines of 36%, 48, 27, 51, 58, and 35 each time. So at the onset of the video, we talked about, man, 85% of the time. That seems like pretty good. And this right here is 100% accurate. So why would this time be different? Because when we look here to the Fed funds rate, the reason why we broke something and the Fed pivoted was because we just couldn't handle the level of interest. So in the 1990s, we could handle 9%. In 2000s, we could handle 6%. In 2005, 2006, 2007, going into the 2008 Great Recession, we could handle 5. In 2008, 18, 19, we could only handle 2. Well, now it's higher by 2x versus 2018, and it's actually it's basically double topping here at 2008 levels, 2008, 2007, 2008. We all know what happened then. However, if we think about the Fitch downgrading, the Moody's and Fitch downgrades, here's what's really different. I'm going to a website called usdebtclock.org, and we're looking here at this one figure right here. And an easy way to think about this is that Fitch is basically telling us that the credit worthiness, meaning are they going to repay back their debts? Well, it doesn't seem as likely now. And the number right here is pretty scary because it talks about debt to GDP ratio. So if we look back to here, what broke the market in 2000? In 2000, the debt to GDP was only about 57%. So looking at the 57%, and we look back to the number, oh man, so at 6.5%, when the load or total amount of interest we were carrying was half, something broke. That was the great drop of the dot-com boom and bust. Do we have anything similar now? Oh my goodness, we have AI. Yes. So now today, the current level of debt to GDP is 119%. Easy way to think about that is like, let's pretend you make $50,000 on your paycheck. You owe basically $60,000 in credit card debt. I'm oversimplifying it, but just think about it that way. You make 50K, you owe 60K. It's going to be very hard to get out of that hole. And we look back here to 2019, we're only at about 2.4%. That broke it. And ever since the lockdowns and all that good jazz, we've been noticing debt's been climbing dramatically. So I'm not trying to be an alarmist. What I'm really trying to do is to make sure we understand that right now we are having a massive push-pull between the two different scenarios. And if all we think about is the technical part, and there is that big warning from the 10-year note we can talk about a little bit more, what makes it so simple for me is if we close out another red week, it might be a bad one. So we know we got those that pattern right here where we have 2 red weeks in a row. We go below the we close below the weekly low, and then it pretty much just starts to waterfall, shallow dip. So what we're hopeful for if we're bulls is that we're going to get that shallow dip. But we know that we sell greed, and man, the market's been greedy for an extended period. What does that mean? It means we should not be really looking to buy this. So let's go back in time and see whether or not over the last year we're buying greed or we're buying fear. A year ago, we're at 65. Now we're at 66. A month ago, we're at 78. A week ago, we're at 69. Today, or yesterday, we're at 67 and 66. So if we buy fear and sell greed, the market's been greedy for a year, and we're getting a crash warning. I really hope you're hearing my message of we have to be prepared. And if not, I'm going to leave you with the warning we talked about for the crash signal going into a couple of weeks ago. But if you're interested in joining us, you can go to thealgo.com to trade with me, Justin from YouTube, for 14 free days to see how I'm taking all of these notes to formulate a plan. And if not, that crash signal warning video should now be queued up here on the left-hand side. Thank you so much for tuning in. I look forward to seeing you on the next one.